Okay, so let us start the class. Very good afternoon and welcome back to CGP Mentors. We are going to start with chapter 2 of your analysis of financial statements, right? This is what we are going to study today. In this particular chapter, we need to talk about the financial statements, ratios, fund flow and cash flow, right? This is something that we'll be doing in this particular chapter. Now, number one question, if you see under section 129 of the Companies Act, which of the following scenarios would require additional disclosure beyond the financial statements? Now, they are talking about which kind of disclosures would be needed over here. So, number one, we have when compliance with accounting standard provides a true and fair view, when the company's financial position cannot be adequately represented by adhering to the accounting standards, when the auditor requests more information, or when the shareholders demand extra details. Now, in this particular question, what is required? Number one thing is, when you need the additional disclosures, it is when your financial position cannot be adequately represented, right, by the adhering to the accounting standards. Sometimes what happens is that even if you follow the accounting standards, you need the additional disclosures, and that is why the notes to accounts and the other questions came into the picture. Now, question number 2 we have, which of the following best explains why financial statement must be prepared on a going concern basis? To ensure that assets are valued at liquidation, to assume that business will continue operating indefinitely unless evidence suggests otherwise, to classify all liabilities as current, and to prioritize short-term profitability over long-term sustainability. See, you can expect the questions from your accounting principles as well. Some example based questions is something that you can expect from here, and this particular question talks about the going concern basis. In going concern basis, they are assuming that the business will continue unless the evidence suggests otherwise. Basically, we are not valuing our assets on the liquidation price. The answer is no. Why? The what you can say point that has to be raised over here is that on going concern basis, your entity is going to continue for a longer period of time, and that is why we value our assets and we put them in balance sheet, because we assume that in next year also we are going to operate, and that is where we will pick our assets value from. That is your balance sheet. ठीक है, हम वहां से अपनी balance sheet की value pick कर लेंगे. This is question number 2. Now, next is, how might investors use the EPS metric when analyzing the financial statement? To evaluate company's ability to pay dividend, to assess the company's operational efficiency, to measure the return on equity investments, to determine the liquidity position of the company. So over here, see, this comes from financial management topic also. ठीक है, ये FM के topic से आपका आएगा earning per share metric. Why EPS metric is important? See, what happens is that it shows what you are earning, and ultimately this EPS metric goes to the equity shareholders. इस किसको चला जाता है? Equity shareholders को. Now, at the end of the day, what is the amount that the company would like to pay? कितना amount company pay करना चाहेगी? That depends on the company itself. ठीक है, वो company के ऊपर depend करता है कि वो dividend कितना pay करना चाहेगी. So over here you can get confused between the two options, but the correct answer is C. It will never be the answer A. ठीक है, option A नहीं होगा. Why it is never be the option A? Reason being over here, because you can have any amount of earning, but that does not decide that what is the dividend that you will be paying to your shareholders. ठीक है, आप कितना dividend pay करेंगे वो इससे determine नहीं होता है. Next is, a company revalues its fixed assets upward due to rising market prices. Which accounting concept does this violate? Historical cost, matching concept, conservatism concept, or full disclosure concept? You are revaluing upward due to rising market price. Basically, this is going to violate your historical cost concept. ये कौन सा concept आपका violate करेगा? Historical cost concept. The reason being over here, historical cost concept asks you, it tells that one should record their assets at cost, the value at which they have purchased it. Reason being, that is going to continue for a longer period of time, and market price, they vary over the period of time. Okay, over the period of time they are going to vary, and that is why what happens is, when you are valuing your assets and liabilities on the basis of market price, what it leads to is the, what you can say, your balance sheet becomes volatile, right? Your balance sheet becomes volatile, and that is why the correct answer over here would be violation of historical cost concept. Now next is, company delays recognition and expense until the next accounting period to improve the current year profitability. Which accounting concept is being compromised over here? Revenue recognition, matching concept, consistency concept, or materiality concept. So over here you are violating the matching concept. Why you are violating the matching concept? Reason being, आप अपने करंट ईयर के रेवेन्यू को यू आर नॉट मैचिंग विद द एक्सपेंस, ठीक है? द रेवेन्यू एंड एक्सपेंसेस शुड मैच इन ऑर्डर टू अराइव एट प्रॉफिटेबिलिटी. आपको प्रॉफिटेबिलिटी पे पहुंचने के लिए यू हैव टू मैच बोथ ऑफ दीज, एंड दैट इज व्हाई यू आर गोइंग टू गेट योर प्रॉफिटेबिलिटी स्टेटमेंट. सो इफ यू आर नॉट मैचिंग द रेवेन्यूज with your what you can say expenses, it is going to hamper your profitability, and ultimately you are violating the matching concept. आप क्या violate कर रहे हैं? Matching concept को. Moving forward, talking about the next question, in the context of bank's balance sheet, which of the following would not typically appear under non-current liabilities? Long-term borrowings, deferred tax liability, deposits payable within 1 year, or lease liabilities. See, lease liabilities are for longer tenure. Deferred tax liabilities comes under the non-current liabilities, right? Long-term borrowings, obviously, they are going to come under the non-current liabilities. What is not, what you can say, will be classified under non-current liability is deposits payable within 1 year. Anything in your what you can say curriculum, when we talk about the current liabilities and current assets, we also talk about the deposits which are payable within 1 year. If there is any kind of liability which is going to be payable within a year itself, this is something we call as the current liability, and that is why we do not take it to the non-current liability portion. Okay? Now next is, what do we mean by the operating cycle? So operating cycle is something that impacts your working capital requirement also. ठीक है, आपका working capital क्या होगा? And when I mean to say working capital, I mean to say the difference between current asset and current liability. So what is going to be the amount of your current asset? What is going to be the amount of your current liabilities? And this is going to determine by the your operating cycle. So time between purchase of raw material payments to suppliers, time between acquisition for processing and realization in cash from sale of goods, always fixed at 12 months. Time between issue of shares or payment of dividends. Whenever we are talking about the operating cycle, we always mean to say that what is the core business activity of the entity. ठीक है, core business activity क्या है? So time between the purchase of raw material and payment to supplier, time between acquisition of assets for processing, realization from sale of goods. The correct meaning over here would be time between acquisition of assets for processing and realization from the goods. Why we have not chosen the option 1? The thing over here is, time between purchase and payment to suppliers. This is a very short period of time. Basically, you are saying that you have purchased the raw material and then you have paid to the supplier. It is not talking about the finished goods conversion. ठीक है, आप finished goods conversion के बारे में तो बात ही नहीं कर रहे हैं. So when you will be including that also, that is something we call as the operating cycle, right? Time between acquisition of assets for processing and realization in cash from the goods. So starting with your assets, in my assets, I will include everything, be it stock, be it my fixed assets, any kind of assets. And ultimately, when I will be realizing from the sale of goods, that is when the whole cycle will be completed. Now next is, a bank projects a 12% growth in deposits from 12,000 crore to meet future funding needs. Okay, if the current loan to deposit ratio is 75%, what will be the projected loans? ठीक है, what will be the projected loans. Now in this question they have given you growth in deposit from 12,000 crore to meet the future funding needs, ठीक है. If they have given you the deposit and if they have provided you that loan to deposit ratio, that means loan in numerator, deposits in denominator, will give you a 75% ratio, and they have asked you simply what is going to be the projected loans. So in this particular situation you will be able to solve it. First of all, find out what is the projected deposits in this particular case. How will we able to find out the projected deposits? So your 12,000 crores multiplied by 1.12, that is your growth percentage, right? Over the period of time, how much do you expect your deposits to grow? That is 13,440. Then you have your projected loans. Projected loans कैसे निकालेंगे हम? See, I have the deposits with me. Okay, I have to find the numerator, right? I need to find the numerator, and I also know that what is the percentage over here. So deposits multiplied by 75%, I got the amount of my projected loan, that is 10,080 crores. कितना आ जाएगा वो? 10,080 crores, that is the amount of my projected loans. Now next I have, a company expects its revenue to grow by 18% annually. If the current revenue is 2,000 crore, what will be the revenue after 4 years? Now over here they have asked you about the growth which is compounding over the period of time. Compounding over the period of time means, suppose I have invested a principal, now whatever interest I have earned, that will also be invested along with that particular principal. Now in the next year I'll be earning on my principal as well as with interest, ठीक है. अगले साल मैं principal पर भी कमाऊंगी और मैं interest पर भी कमाऊंगी, दोनों portions में मैं कमाऊंगी. So this is called as the growth. Now how shall I be able to find this out? So whatever is your current revenue, 1 plus growth rate and to the power years. What are the number of years over which you are expecting the growth? So in this particular situation, just wait for a second. Yes. So in this particular situation, I will be able to find out my growth, 2,000 crore multiplied by your growth, which is compounding over the years. So 1.18 to the power 4, I'll get this value, and this is going to provide me what my revenue is going to be after 4 years. 4 साल बाद में मेरा revenue क्या होगा? Now next is, a bank holds 800 crore in high quality liquid assets and expects cash outflow of 600 crore over the next 30 days. What is the liquidity coverage ratio? Right. So over here we have came to the ratio component of your financial statement analysis. ठीक है, हम आपके ratio component पे आ गए हैं. 120%, 133%, 150%, 166%. Right. Over here, how you will be able to find out? So liquidity coverage ratio can be calculated with high quality liquid assets divided by what is the cash outflow that you are expecting over the next 30 days. अगले 30 दिनों में आपका क्या cash outflow है, that you have to divide. So high quality liquid assets divided by total net cash outflow, we have 133.33%. ठीक है, कितना है? 133.33%. Now next we have, a bank's tier 1 capital is 3,000 crore and a risk weighted assets are 20,000 crore. Now what is the tier 1 capital adequacy ratio? See, what happens is, in tier 1 capital, what kind of capital we include? We include equity, we include preference, we include reserves and surplus. ठीक है, ये आपके first tier 1 capital में आ गई. This is also called as your primary capital. ठीक है, हम इसको क्या कहते हैं? Primary capital भी कहते हैं. When we'll be talking about the regulations, you will right now, because this is included in the financial statements, we can only talk about this particular matter. But as we will also talk about the Basel norms in your subsequent lectures in other modules, there you will get to know that what would be classified under tier 1 capital, right? So all these questions then would be combinedly made with the kind of understanding we will get from those lectures also. Tier 1 capital adequacy, I feel divided with what kind of risk weighted assets we are having. Risk weighted assets means the loans and advances as a bank that you have provided multiplied by what is the risk weight assigned to that. For example, personal loan would be an expensive proposition, right? Apart from that, home loan would be a safe proposition. So accordingly, we will assign the risk weights, right? So over here, the clear simple answer would be 3000 crore divided by 20,000 crore multiplied by 100. 15% is your capital adequacy ratio, right? Now next question is, a company's working capital increased from 400 to 500 crore during the year. If net profit was 200 and depreciation was 50, what were the sources of funds? Now this comes from the chapter of your fund flow. ठीक है, ये आपका कहाँ से आता है? Fund flow के chapter से. Whenever we talk about the fund flow, they are asking us about, they are going beyond the cash flow concept. In cash flow concept, they are genuinely thinking that okay, if there is increase in cash or decrease in cash, this is all what we are concerned about. But in case of fund flow concept, they goes a step beyond and they talk about the working capital in general, whether there is an increase or decrease in working capital, right? So company's working capital has increased, okay, net profit was 200 and depreciation was 50. So what are your sources of fund? Net profit plus depreciation plus increase in the working capital. What has been your increase in working capital? So 100 crores is the increase in my working capital. Good, right? That is number one source. Number two, I had the profit. Good. Depreciation is also one of the source. So my sources of fund would be 250 crores. Now next is, consider the following figures and calculate the earning before interest, depreciation, tax, amortization margin ratio. So over here, EBIT is 150, depreciation is given, amortization is given, sales is given, return outwards is given, return inwards is given. Now in this particular question, while we want to calculate the EBITDA margin, where whenever we talk about the sales, in that particular case, we have to talk about that this should be a net sale. Net sale means sales less return. But when they have provided you return outwards also and return inwards also, outward means you are sending, inwards means the return is coming to you. So return inwards is something which is your sales return, जो आपकी क्या होगी? Sales return होगी. So EBITDA margin, profit after tax, if that is given to you, plus interest, plus depreciation, plus tax, plus amortization, right? So over here, just wait for a second. I have been provided with EBIT, earning before interest and taxes. Okay, so this PAT plus interest plus tax, these three will be together as 1,50,000 because there is no distinction provided to me in form of PAT, profit after tax, and interest and tax. They have not given me. They have directly given me EBIT. So I will write my earning before interest and taxes. This is what they intend to do. After that, I will take the depreciation. I will take the amortization. I will divide it with net sales, that is sales less sales return. Okay? Sales less sales return, and this is going to give me my EBITDA margin. Whenever they are talking about the margin, essentially they want you to calculate sales figure itself. ठीक है, वो क्या calculate करवाना चाहते हैं आपसे? Sales figure calculate कराना चाहते हैं. Now next question we have, and they are asking me to calculate the return on capital employed. Always remember, the capital employed can be calculated from two ways. You can calculate it through asset side and you can also calculate it through liability side. Right, over here they have given me the EBITDA 360, amortization 50, interest 20. Asset side of the balance sheet is 8 lakh. Okay, share capital is 4 lakh, reserve and surplus is 2 lakh. They have given me the balance sheet side of the asset, right? And they have given me share capital and they have given me the reserve and surplus. Now over here, return on capital employed, how we are going to calculate? EBITDA divided by total of asset side or balance sheet. Okay, so you can take from the asset side, you can take the reserve, surplus, share capital also, but in this particular question, share capital and reserves, only that particular figure has been provided. So I will go on and I'll proceed with the asset side of the balance sheet, right? So over here, 360 divided by 8 lakhs, 45% is my EBITDA, my return on capital employed. ठीक है, I am assuming over here that the asset side of the balance sheet figure has been given in complete senses. Okay, Now next we have the leverage ratio, we have term liabilities, we have current liability, we have share capital, we have reserve and surplus, and we have the goodwill. Now in this particular question, whenever we are somebody is asking me to calculate the leverage, leverage ka matlab hota hai that what is your own money that you are having and what is the money that you have borrowed. Leverage in essence it means that by using the debt funds, what is the return that you are giving to your equity shareholders. आप debt funds use करके equity shareholders को क्या return दे रहे हैं. This is the leverage. This is the advantage that your equity shareholders are getting because you are using the debt funds. Okay, so that is the rationale over here. Leverage formula that is given as per the IIBF is total outside liability divided by tangible net worth. So term liabilities plus current liabilities will be my total outside liability, right? Total outside. They are not mentioning the long term or short term. They have said me total outside liability. Then they are asking me tangible net worth. That means they will not include the intangible assets. So net worth, what would be my net worth over here? Share capital plus reserves, 5 plus 7. Yes, 5 plus 2 is 7. That is my net worth. But out of that, they have asked me that please remove the intangible part, that is goodwill has to be removed. अगर और कोई intangible asset आपकी होती है, you have to exclude it because we are talking only about the tangible assets over here, and this is going to provide me my leverage ratio 3 lakhs divided by 650, that is 46.15%. Now next question we have the vanquish ratio. Now this kind of ratio, this is not very frequently mentioned by the ICAI, right? ICAI does not mention it, but your IIBF book mentions it. So that is why we have included it. EBITDA has been given 360, amortization 50, interest 20, asset side of the balance sheet 8 lakh, share capital 4 lakh, reserves and surplus 2 lakh, long-term debt 2 lakh. Now from the name itself it is not clear, but this is a kind of ratio which tries to represent your debt, right? Your debt segment. So let's see over here, the vanquish ratio, the formula is long-term debt divided by the EBITDA, right? What is the earning that you are having and how much it is going to cover your debt, ठीक है, कितना ये cover कर रही है. So 2 lakh divided by 360, this is my formula over here. Because the EBITDA has been given at 360, long-term debt has been given at 2 lakh. One thing that you need to remember over here is vanquish ratio means how quickly your debts are going to disappear because they are covered by the earnings, ठीक है, क्योंकि वो earnings के through covered हैं, so how quickly they are going to disappear, this is something that we tend to measure from the vanquish ratio. Now next we have the SIP holding ratio, work in progress opening has been given, closing has been given, cost of production has been given. Now it's a very simple kind of ratio, SIP holding, stock in progress holding ratio. क्या है ये? Stock in progress holding ratio. So very simple, it's just like inventory turnover ratio. You have to use the cost of production divided by, you have to use what is your work in progress in average, ठीक है. Why I have included this question? Because we don't have to be confused when they mention the SIP holding ratio. If they have mentioned the SIP holding ratio, don't be confused. You know that they are talking about stock in progress holding ratio. ठीक है? So it would be your stock in progress average stock multiplied by 365 divided by your cost of production, right? And it is going to be 9.125. ठीक है, कितना होगा ये? 9.125. This is your average stock and this is the kind of formula that your IIBF book mentions. So a kind of a different formula than your inventory turnover ratio. So please remember it. Now, as per Ind AS 24, which of the following transactions should not be identified as related party transaction? This particular thing has been mentioned very predominantly in your book. So that let's read this. Both entities are joint ventures of the same third party. One entity is joint venture of a third entity and the other entity is an associate of third entity. Entity is a post-employment benefit plan for the benefit of employees of either the reporting entity. Two ventures because they share joint control over a joint ventures. See, what happens is, why the option is D? Why the correct option is D? There is answer to that. India's 24 clearly identifies that when a transaction would be called as related party transaction and when it will not be called as a related party transaction. Dekho, when it will be called as a related party transaction, when a person or close member of the family is related to reporting entity, they have control, they have significant influence, they have a relationship of key managerial personnel. If entity is related to a reporting entity through, they both are members of same group, one is an associate or joint venture of other entity, both are joint ventures of the same third party, one entity is a joint venture of third entity, right? The entity is controlled by a person identified in A, that is a person or a close member. But what is not included over here is, that is something we have to focus on. So you are not going to call two ventures simply as a related party because they share the joint control over joint venture. No, that will not be called as a related party. They are providers of finance, trade unions, public utilities, customers, suppliers. They are not called as related parties. Related parties in essence is called when one is having the significant financial control over the other, right? You are exercising a kind of control over the other party, and that is why you are being called as the relative. You are simply sharing a joint control over joint venture, and in this situation the two ventures, they do not have any control over each other. दोनों का आपस में एक दूसरे के ऊपर कोई control नहीं है. So in this situation they will be called as a, they'll not be called as a joint what you can say related party. Now you need to calculate the cash flow from financing activity. So proposed dividend has been given 20,000. Your closing of proposed dividend 15,000. Equity share capital raised 3 lakh. Debentures redeemed 1 lakh. Preference share capital redeemed 50,000. Interim dividend paid during the year is 20,000. So in this situation, cash flow from financing activity, equity share capital raised, it's a plus, you will be getting the money. 10% debentures redeemed, it's in negative, you will the money will go out of from your pocket. Preference share capital redeemed, money will go out of your pocket. Interim dividend paid, money will go out of your pocket. Now in case of proposed dividend, what happens is, see, the last year's dividend you pay and the current year of dividend is something that you provide for, right? So over here, what would be your answer? Equity capital less debentures redeemed, less preference share redeemed, less interim dividend paid, less proposed dividend. See, proposed dividend is a final one, okay? And the figure of last year whatever you have saved, you will pay this in current year, and current year what you are saving, this you will pay in the next year. So when I'm talking you to when I'm asking you to calculate cash flow from financing activity, I'm asking you that what is the amount you have actually paid, आपने कितना amount actual में pay किया है. So this is something that would be classified over here. Now number 2, proposed dividend, interim dividend, what is the difference? So interim dividend is a kind of dividend which is paid between two AGMs, annual general meeting, right? And your proposed dividend is given to the shareholders on the AGMs usually. So that is why they both are different over here and they have been deducted separately. Next is ABC Limited purchased machinery for 9 lakhs. It received a dividend of 70,000 on investment in shares. Okay. Also sold an old machinery worth 79,000 at a loss of 10,000. You need to compute the amount of cash flow from investing activity. Purchased a machinery, okay, money has gone out of your pocket. Received dividend, yes, you have received the money. Sold old machinery, book value was 79,000, loss of 10,000, that means you have got 69,000. आपको कितना मिला है? 69,000. So clearly over here, money went out, I received the dividend, I sold the machinery, right? This is what my cash flow from investing activity would be. So these are the questions that we had to discuss in the analysis of financial statement. Now we will talk about the next chapter in our next video. Thank you so much for joining in.